just fire up the Nifty once again, 0.5% up. And mid-caps are showing plenty of traction. So I think the market is taking the view that right now at the index level, you'll be trapped in a range. Best to look at individual stocks, and that's what seems to be happening as of now. Tata Communication, Reddington, Gabriel India, lots and lots of mid-cap names up and about. Thomas Cook up about 6%. So plenty of names on the mid-cap and small-cap screen which are doing well today. Okay, let's welcome in our next guest on the show. Kashyap Javeri, who's fund manager and head of research at MK Investment Managers, is joining us for review now. Kashyap, good to have you with us here on Money Control. Thanks for joining in. So we're speaking at a time where the market continues to be in a logjam. FPIs continue to sell and Indian investors are wondering what next. So just give us your overall thought process on the market right now, how you have looked at your portfolios, and what is the investment thinking in a market which has been unquestionably difficult for the past 6 months to a year now?
Thank you so much for having me on the show. So broadly, we are staying put in our portfolios. We are not taking any knee-jerk reactions at this point of time. I think, since last about 2.5 months, we have all been waiting for that elusive ceasefire to happen, and even as of today, it remains quite elusive. But not having known when that could occur, I think the best way to play this out is how we have done with our playbook during the time of COVID or during the time of Russia-Ukraine war, which is to stay firm in our portfolios, having built positions which are built on impeccable management integrity and capability. Such exigencies keep happening and they only help us at some points of time to buy stocks which we have until today not been able to buy because of the valuations not being in our favor. So I think the way we are using this volatility is to stay put in our portfolios and at points of time deploying cash in some of the stocks that we like a lot, but because of valuations we have not been able to play up.
So expand on that, Kashyap. Okay, let's start from the top because our viewers really want to understand what your portfolios are looking like now. So first of all, the whole question between large cap bias, mid cap bias, small cap bias. What is the overall construction looking like across different strategies? Obviously, you'll have different portfolios. What's the house view?
So as a house, we like to play it in a very flexi cap manner. We are market cap agnostic and we are sector agnostic as such. So the opportunities can keep coming up.
No, but for the current environment, Kashyap. I meant like more right now in the current environment where earnings have been challenging. Yeah.
Yes. So I think let me first take on the earnings side. I think if you look at the Q4 earnings, broadly earnings have been more sort of resilient in the mid cap space, having grown in terms of revenue, EBITDA and PBT upwards of about anywhere between 18 to 20%. That followed by small cap where we have seen earnings growth in mid-teens, and that followed by large cap where we have seen earnings grow by single digit number. So having said that, yes, the earning tilt is towards at this point of time more towards the mid cap side, that followed by small cap and that followed by large cap. Our portfolios are now today across the market cap, and it's based on what the risk appetite of a particular client is. But like I said, having said that, irrespective of market cap, we are market cap agnostic or sector agnostic. We will sort of invest in opportunities whether they rise in any kind of market cap, so far as they sort of justify the returns coming out of that particular company's quality as well as the kind of market cap that we are playing into. It's very it's very obvious that if I'm initiating a position today in small cap, my margin of safety should allow me to make at least about anywhere between 28 to 30% compounded return over a period of next 3 years. If I'm looking at large cap, I'm okay with earning anywhere between 14 to 17% kind of a return. But like I said, the market conditions probably will not decide which kind of market cap or which kind of sector I want to play into. It's going to be more bottom-up approach if I'm looking at our portfolio point of view.
Sure, sure. But, in terms of themes, while obviously it's going to be very, very granular and bottom up, in general, like I looked at your, for instance, your capital builder, strategy, where financial services are a large chunk of that theme. I think 30% of that portfolio is in financial services. I can see healthcare, which is almost 19-20%. Autos and auto ancillaries, 12%. So, across the house, or since you also had research, in terms of sectors for the next 1-2 years, as this earnings profile changes, where do you have the highest conviction and why?
Yes. So I think if you look at sector wise, and I think that's more coming from the point of view that we have selected stocks which is making up that sectoral composition. But having said that, by not by sort of design, but by default, if you look at across our portfolios, where we are slightly more bullish than maybe other sectors, not having anything agnostic against sort of other sectors, but we are fairly confident on auto ancillary. We are quite confident on healthcare, but within healthcare we are sort of overweight on CDMO plus CMO both put together, and that followed by to some extent in capital goods. And along with that, if I look at the hierarchy, there could be financial services, and within financial services, private banks, and plus some of the NBFCs put together. So if I look at broader hierarchy, as a house, it could be auto ancillary as fairly heavyweight. That followed by healthcare. Within that healthcare, CDMO and CMO, and not necessarily the US generics or branded formulation kind of place, but more about CDMO and CMO kind of place, and that followed by probably at third in hierarchy, it could be financial services, capital goods, and to some extent some of the other sectors also. But like I said, hierarchy is this.
Okay, that helps. That kind of gives us some idea about what you like. So let me ask you, auto and auto ancillary, Kashyap, what gives you that confidence? Because I think the last couple of months have been fantastic. Ever since those GST cuts happened, I mean, the earnings profile completely changed. Even a company like Maruti, which was not selling enough of its small cars, I mean, look at the numbers, they're so different today, right? But now,
Absolutely.
What gives you the confidence that that kind of a volume run rate will still continue despite elevated fuel prices and the base effect catching up? So what's the thesis on auto OEM especially?
Yes. So I think, if you look at broadly our auto ancillary exposure, I think we are playing three-pronged, approach there. Point number one, GST fueled auto volumes, as you also highlighted. I think that's one part of it which is playing out. The second is that we are playing on auto ancillaries where value per vehicle is moving up, in the sense that they are either moving into vehicles which are higher in terms of upward mobile chain, or we are looking at more products within the same portfolio or same vehicle, or we are looking at the third and last but not the least, some of the auto ancillaries which are expanding beyond auto ancillary, right? If you look at auto ancillary, the way we look at it is that India as a country is a process champion. We know metals, we know how to process metals, whether it is stamping, forging, casting, and now we are making a big name for ourselves into machining those components. And the utility of those components need not be just auto ancillary. The same component in different sizes and forms can be used in whether defense, aerospace, or off-highway vehicles also. So I think these are the three-pronged strategy that we are playing into auto ancillary. A, volume driven, B, content driven, and C, expansion of the portfolio. And last not but the least, in terms of volumes, what we are also looking at is that there is a base effect until September or October this year in terms of auto volumes, because GST cut played out post September 2022 in last year, in 2026, and that base effect is going to continue for a while. The second thing that we are looking at is that if I look at FY27 and then gradually in FY28, some of the other triggers are also there down the line, in the sense that broadly if I look at the rural portfolio, there is a significant favorable base effect as well as income play, which is yet to play out over next about, let's say, 6 months. And FY28 onwards, you will also have an impact of overall pay commission, which will come into effect on retrospective basis. So I think at least in four-wheelers, we are reasonably sure that growth will remain at either a high single-digit number or early 10-digit kind of a number. That followed by two-wheelers. So I think volume side, I would probably say that the volume growth might actually continue through early part of 28 financial year also.
Okay, that's auto. Now I'm also noticing, of course, financials, and you mentioned you like private banks, among others. And very interesting, in the capital builder portfolio at MK, I see HDFC Bank as being one of the top picks. There's also ICICI Bank, there's Federal Bank. And in the small and mid-cap portfolio, there are names like IndusInd Bank, Federal Bank, Max Financial. So even Pine Labs, Pine Labs sits at the intersection of technology and financial services. So very, very interesting plays there. Kashyap, I'm sure a lot of people are wondering, how is it that someone like you keeps the faith on an HDFC Bank, right? It's tested investors' patience for so long, one of the most loved stocks of India, but it's come under such rough weather for so long. So just explain the thought process around that, and just your broader thinking on financials, lending, non-lending. How are you thinking about the whole universe?
So it will be difficult for me to provide a stock specific input because by regulations I am not supposed to do that. Having said that, I'll just give you a top down or let's say a slightly bottom up approach on what selection process has been. I think broadly our thought process is that NBFCs in India have been sort of conduit of making the banking or let's say lending practices right down to the last mile. And they have done it extremely, sort of diligently without compromising on asset quality. Some of the financial services in non-banking space have been able to raise capitals that we have never seen before in our life. They have been able to, sort of raise capital so easily and in vast amounts. Third and last not but the least is that as and when they have, as they have sort of gone through this whole rough patch of last about 10 to 12 years without having any impact on balance sheet. What we have seen across most of the NBFCs, and I'm not pointing out to the ones that we have held in our portfolio, but across NBFCs, what we have seen is significant upgradation in terms of credit rating, which also poses a significant amount of confidence coming from credit rating agencies. That also has seen a definite impact on their cost of borrowing. So what we have seen in case of NBFCs is decent growth in loan books. What we have seen is a decent stability in cost of borrowings. Maybe that has remained stable in a rising interest rate scenario or gone down when the rates have gone down. What we have seen is, credit costs despite COVID, despite Russia-Ukraine war, despite Iran-Israel war or Iran-US war, credit costs have remained significantly under control. And over a period of time, what we have seen is that the valuations either have seen a time correction or in some places has seen even value correction. So great numbers and good valuations, I think that combination has worked in favor of non-banking financials. In terms of banking, what we have done is our portfolio is more tilted towards large private sector or mid private sector banks. What we are looking here at is that over a period of last about 5 to 7 years, consistent increase in the market share on the deposit side for the private banks clearly gives them a significant advantage over probably other banks in the system. We look at banking more like any other manufacturing company. A company which can raise the raw material at the cheapest possible price from the largest amount of vendors is somebody who is supposed to be the winner of that particular sector. And if I look at banks, within banks at private sector banks, they are expanding their distribution. They are raising money at rates which are cheaper than their peers in other segments. And over last 7 years, again, like in case of non-banking financials, what we have also seen here is absolutely no let up on the asset quality. Despite having seen all three events in last about, let's say, 7 to 8 years. Valuations have seen both time as well as value correction. and I'm saying this across most of the private sector banking, financial as such, and not specifically to what is in our portfolio, but I think across the space we have seen significant value as well as time correction in the valuations. So I think that makes us quite positive there. But I would refrain from making comment on individual.
Kashyap, no, that's okay. That's okay. I get that you can't talk about individual stocks in your portfolio. Just a follow-up question on banks and financials. I mean, till now it's been all pristine, right? Decent credit growth, good quality books, no NPA issues. But here onwards, as the real impact of this war starts going through the system, though the government came out with that credit guarantee scheme, where do you see the asset quality stress showing up, if at all? So what should investors be wary of when they're buying into financials today? And which part of that financial curve, banks, non-banks, PSU, private, large, small, where could the asset quality trend show some deterioration that investors must be aware of?
So I think when we look at broader picture as such, we usually there are nuances that we also need to look at, right? For example, if you look at RBI data, which comes on quarterly basis in terms of where the credit growth has happened, in which interest rate category, in which size of the credit category, I think everything points out to the fact that the financial services industry in this country has been extremely vigilant about not creating the same scare of NPLs that we saw between probably 2012-13 to almost as late as 2018-19. A couple of data points that I usually look at, or we as a house usually look at. One is the credit utilization ratio, which is usually the disbursal to credit sanction ratio for large corporates. That ratio is today at significantly lower rate, which means even though I have open credit lines, I have shied away from using them. The second usually point that we look at is where the credit growth is happening, whether it is in large ticket loans, whether it is in small ticket loans, whether it is in mid ticket loans. Over last about 7-8 years, what we have seen is that the category where the previous NPL cycle occurred, which is a very large corporate exposure, I think that's not been growing at all for last about 7-8 years. So I think the large chunky NPL scare which happened during that period, I think we can rule out at this point of time. The third part of it is that if you look at the breakup of the type of loan which have grown after RBI raised the sort of guardrails on small ticket personal loans, on MFI exposures, on credit cards, I think what we have clearly seen is that some of this unsecured portfolio growth has significantly slowed down in overall credit growth. So I think overall what all these data points sort of point toward is that the banks have been very vigilant in terms of where they are disbursing the loans, how much credit utilization is happening in the system, at what kind of capital the CAR ratios that they are working on, the capital ratios that they are working on. And broadly, if you look at last but not the least, the provision coverage, which is not specific to NPLs, that these banks have created over a period of last 7 years is absolutely fantastic. Just to give an example, and don't be hold specific to a particular name, but let's say, for example, 3 large private sector banks, their provisions which are not attached to a particular NPL as a percentage of their net worth is anywhere between 7 to 10%. Your about 7 to 10% of net worth is already in the provisions which are not assigned to specific loans and which can be used at any point of time down the line. I think if you look at all these numbers alongside this kind of exogenous events, I would say if they are short term, it should be very easy to pass through. A medium term, maybe some bit of mild pain. But at this point of time, I don't know whether this will last any longer than even probably tomorrow or day after tomorrow, right?
Sure.
So I think that's the way I would look at it. There is a systemic strength which is there at this point of time. And I don't think I would be scared for NPL at this point of time.
Yeah. Okay, that's a very strong, well-rounded and compelling argument. Explains why you're still very, very optimistic on financials and at MK Investment Managers, you like the auto space as well. Perhaps we'll speak about your call on healthcare and some of those capital goods names perhaps on another time. But good conversation. And I think, Kashyap, hearing you, our viewers will feel pretty reassured. You don't seem too fazed by this war or the fact that the market has been range-bound, but you're going ahead with your investment bets. Thank you for joining in, and we hope to see you again soon. Thank you.
Thank you so much.